Alright, so in this video, I wanted to go over my portfolio with Questrade, how I manage it, my thought process. And this portfolio is all about selling options. So if you're interested in selling options, this could be a video that might interest you. Otherwise, if you're more into dividend investing or a buy and hold, it's probably not going to interest you. So I've got 4 different accounts with Questrade: a margin account, a TFSA, an RRSP, and an RESP. And the total equity in Canadian with Questrade is 127,000. So now I'm going to go through all the positions that I have. So my total balance in my margin account, total equity right now, if we look at the combined, it's a negative 4,600 Canadian. That's because my market value is very negative. And the reason my market value is negative is because I sell puts in my margin account. So they right away they come with negative market value. But if they drop even more, if the stock drops even more than the put value increases in value, the put option increases in value. So it has increased more than the initial credit I collected. So that's why my market value is higher than my cash, giving me a negative equity. But this is not confirmed loss yet because the trade is still open. So if I go to positions, first trade that I have here is a naked put on AI expiring September 17. So this is a 50 strike. As you can see here, it says average price 486, but this is actually a roll trade. So 486 is not exactly the total credit that I received. And it's showing that the price that it's trading for right now, this 50 put option, is $5.08. So it's showing a P&L of 22, but it's actually a lower P&L because the total credit that I received on this trade is $4.02. So I'm actually down almost $1 on this trade. So that's an extra market value of a negative 100. If I go back to balances, that's one way of explaining the difference, the gap between the cash and the market value, is that I'm actually down an extra $100 on this trade. Next here, I've got a naked put on Curiosity Stream expiring November 19. It's a 17.5 put. So this is because it's November 19, this is one of those trades where I had to roll all the way to November or December just to try and save. I think Curiosity Stream is trading at around, I don't know, 12 or something. Yeah, $12. So yeah, I've got to put at 17.5. So I'm completely in the money. I had to roll it all the way to November. Now it shows here average price $9. So that's not what I collected in total. What I collected in total on Curiosity Stream is $3.32. And right now the stock is trading at, or the put option, sorry, is worth $5.65. So I'm actually down about $200, right? And it's showing here a profit of $338, but that's not correct because this was a rolled trade. So my total credit was I logged my credit, so my total credit is $3.32 and it's worth $565. So I'm down 200, I'm not up 338. So that's another reason that explains why my market value is more negative than my cash. Next here, I've got an Etsy put spread. So this is a put spread that I rolled all the way to December just to try and save by increasing the width of the spread. And it's doing fine because I mean Etsy is trading at around 190, I believe. And my total credit on this trade, Etsy here, if I can find it, for some reason I can't find it. Looks like I forgot to enter it, but this was a roll trade. I initially collected $1, probably collected maybe 20 cents max to roll it all the way to December. Obviously, it's not closable right now because I think the spread is worth $2 or $3. So it's not closable, but at least Etsy is trading at 192. So it's pretty far. Just a matter of holding on to it so that I can close it. Looks here, based on the last trading price, it was worth about $2. So it's not closable yet, but getting close. Next here, I've got a Fiverr put spread. This one I opened recently. I opened it after earnings when the stock dropped hard after earnings. So I went to September 17 expiry. I did a put spread at 145, 140. Collected, I believe, $1. Yeah, it shows here I collected $1. Could have done it naked. Would have been profitable by now if I had done the trade naked. But I was concerned about my buying power because my buying power is right over here, about 38 Canadian right now. Total maintenance excess is what I should look at when I sell options. And I think Fiverr was going to take about... Here, let's test it out. So market price, I think Fiverr was trading around, I don't know, 170. And let's say I have the 140 strike. It would take about 2100. But if Fiverr continued to drop, it would increase the buying power required would increase, would go to 4,000, and I didn't necessarily want to deal with that. Reason being is I've got one naked put here that's giving me a hard time. This Spotify put here that I'll get to it soon, but this one's like 20 or 30 points in the money right now, and it's taking up a lot of buying power. So that's for Fiverr. I think it's showing a small profit actually. It's profitable a little bit, but not enough to close. I might just hold the expiry and try to collect full credit out of it because, commissions take up a lot. Next here I've got HIMS. It's a naked put at 17.5 strike. I think HIMS is trading at $8. If we see here, yeah, HIMS is trading at $8. So yeah, that's a pretty bad drop. So almost more than 50%. And the total credit I received on HIMS here, this naked put here, is $2.62. But I rolled it all the way to December just to give myself a chance. For sure, I'm going to have to roll it again. But I collected a total credit of $272, and the price right now for that option is worth $10. So I'm down $800 on this. So that's another reason, that's another explanation to the gap between the market value and the cash. If I go back here, so that's HIMS, and then I've got a put spread on PDD that is completely breached. I've got a 195 put spread. I think it's trading at around 84 right now. So yeah, you can see it's trading at 84. So this one I'm gonna most likely have to roll it as naked. So either I'm gonna roll it as naked or roll it as a put spread, increase the contract, but go super far, like maybe December or even an extra year. So I haven't decided, but I'm leaning towards rolling it as a naked put, but really far as well. So yeah, that's the way I'm going to manage this trade. I've got a Pinterest here, naked put. I've got 2 contracts. I did this before earnings when it was trading at around, 75. It was actually showing a profit before earnings, but I didn't close it because of commissions, and now I totally regret it because now Pins is at 56 and I've got a 65 put. I collected a total credit of, where's Pins over here? So I collected a total credit of $278, and right now it's worth $9.50. So I'm down about $7 or $700, actually times 2 because I've got 2 contracts. So that's another explanation to the gap between the cash and the market value. And all I could do is I'm just gonna wait, keep rolling if I have to, and wait for Pinterest to come back up above 65. Hopefully it does. Then I've got Posh here, Poshmark, which was not a good trade. I entered it initially because I couldn't find any trades, and I think that's a mistake I tend to make, is forcing trades when there's nothing. Moving forward, I think I have to be more patient and more selective in my underlyings. If I don't see a trade, if I don't see an opportunity, then I just won't trade, although it's very hard not to. But yeah, so I entered this for $1.50 initially, and it was far enough, but it wasn't a good enough credit. It wasn't worth it. And then the stock kept gradually dropping before earnings, and then we went through earnings, and it dropped even more after earnings. But before earnings, I rolled it for an extra 50. I rolled it for an extra 75 cents. So that gives me a total credit of $2.25 for this put option here. But it's worth $7. So I'm down about $500 on this one. So that also explains the gap between the market value and the cash balance. So now all I could do is I'll wait till September, and then I'm just gonna have to roll it again. Hopefully Posh comes back up above 35. I think right now it's trading at around like 27.85. Yeah, very sad. Next here I've got a Roku put spread. I opened when Roku was trading around 375, I believe. Premiums are very high on Roku. If I could afford to do a naked put, I would have done a naked put because premiums are super high. I did a put spread instead, collected $1 at a 330, 325 put spread for September 17. So it's not bad. I think Roku's trading at 357 right now. So it dropped since I've entered this trade. It has dropped, and that's why the trade is showing a small loss. I think the spread is worth like $1. I think it's worth $1.50 right now. Next, I've got Snow. So this is a put spread that I rolled just to try and save. I rolled all the way to December. I increased the width of the spread from 5 points to 10 points. And I think this one I've got written down. I didn't forget. So yeah. So I have total credit of $1.30. It expires December 17. Snow is I think is above 260. So it's safe. It's just that it's not closable. The spread is not closable yet because it's all the way to December. But at least I didn't confirm a loss the first time, and I just rolled it. Next here, I've got the famous Spotify that's completely annoying me. I've got a 240 put, and for some reason Spotify just keeps dropping. Let's look at this chart here. I don't know why it just keeps dropping. Yeah, at some point it was 52-week high was 387, and now it's all the way down to 211. It just keeps dropping. Look at this beautiful downtrend. Eventually, I'm pretty sure it's going to reverse, but while I'm holding on to this put, it's definitely hurting my buying power. So let's look at the position here. So see, this put here is right now worth $30, but the total credit that I received on Spotify is should be in the September is $10. So I received a total credit of $10, but the put option is worth $30. So I'm down $2,000. So once again, that's an explanation to the gap between the cash and the market value. So since I'm selling puts, I'm collecting credit. I'm collecting cash by selling the put option. So as soon as I sell the put option, my cash should be equal to the market value. So they cancel each other out. As the put option becomes profitable, my cash remains the same, but then the market value drops. So then my equity increases. So that's where the profit shows here. But right now, the market value is increasing and the cash is staying put because the put option is increasing in value. So that's where the gap is coming from. And so let's look at the buying power that it's taking from me. So Spotify is a 30% margin requirement stock. Market value right now is 211. My strike is 240. So it's taking about almost 10,000 maintenance excess. So it's taking a lot out of me right now, and balances. So you see, if I didn't have my Spotify put, I'd be at 48,000 right now of maintenance excess. Actually, that's US. So I'd be at 40 US, which would be much higher in Canadian. So yeah, it's really hurting me right now. And let's see the difference. If it was trading at 250, I would have been at 6,500. It would have been taking 6,500 maintenance excess out of me. But because it dropped from 250 to 210 or 211, my maintenance excess went from 6,500 to 9,000. So actually, let's look at the increase. So the stock dropped from, let's say, 250. Well, let's look at the difference. So I'm going to do 210 divided by 250. So the stock dropped 16%, but the capital required to hold the trade went up from 9,000 to 6,000. Sorry, from 6,000 to 9,000. So the stock dropped 16%, but my buying power for the trade went up 50%. So yeah, that's the main risk of naked puts, is the buying power required to hold the trade if it goes against you. So going back to my positions, all I could do is really wait. I was thinking of selling calls, but the risk with selling calls is I'm afraid that as soon as I sell a call, the stock comes back up and then my call becomes challenged. And it depends how fast the stock comes back up. If it comes back up gradually, then I can probably close the entire position for profit. But if it comes back up, like it gaps up, and one day we see it up to like 5%, then I won't be able to close the trade. So then I'm stuck holding it, and then now I'm tested on the call side. So that's my concern with selling a call, but I feel like this is probably what I should be doing here because it's hurting me. It just keeps dropping. All right, next. So if I go back to my positions, account positions. So after Spotify, I've got a Sumo put. So this is another one that I rolled all the way to November or December that I'm trying to save. Total credit that I collected on this one here was $3.56. My break even is about 26.5, and the stock or the put option is worth $10. So I'm down about $700 times 2 because I've got 2 contracts. So that's another explanation to the gap between the cash and the market value. Yeah, so that's not doing good at all. And then finally, I've got a put spread on Zillow here. I opened it as a put spread just to start, but I could eventually convert it into a naked put if I have to. I think I opened it for $1.18. Here I have it here, $1.17, but I think the spread is worth like $1.50 right now because Zillow has dropped to 97. But it's a put spread. I've got no problem. I'm gonna hold on to it till September 17. I have confidence that it's gonna be above 95, but if it's not, I'm just gonna roll it as a naked put. So I'm not concerned about that one. So next, in my TFSA, my balance right now is I've got a total equity of Canadian 70,000. My cash is 51 combined in Canadian. But as you can see, my buying power is less than my cash. The reason being is because I'm using my margin account. I'm using the TFSA as leverage to be able to trade in my margin account. Because if you notice in my margin account, the trades that I'm placing use up more than the 6,000 cash available in my margin account. So my buying power in my margin account actually comes from my TFSA being leveraged. So that's why I don't have full buying power in my TFSA right now. So what's good is that I still have a lot of cash in the TFSA. So if there's a crash coming, I've got opportunities this time to buy some stocks in my TFSA. The way I'm treating my TFSA is I plan on doing covered calls. So I want to sell options. So in my margin account, I'm selling put options. In my registered accounts, because I cannot sell put options, I do covered calls instead, which is the same thing. But I try to do it on not expensive stock. I'm not going to do it like on Spotify, for example, because that's going to take $20,000. But what I would do is stocks that trade between $20 and $30. When I see that they've dropped a lot, then I'll do an at the money covered call for like 1 month or 2 months just to try to collect or extract the most premium as possible. And then if it's profitable, I close it. If not, then I just do it again. I just sell a call option again. So for example, let's look at open here. This is a covered call that I did at a 15 strike. So if we go to open here, I initially collected, my initial entry was $13.75 on a 15 strike. So I initially collected $1.25. After earnings, I had really good earnings. I had a chance to close the entire covered call for 15. So then I confirm my $1.25 profit. I decided to roll it for an extra 55 cents at the same strike. So that now I've got a net debit of $13.20, giving my potential profit, max profit of $1.80. Now $1.80 over 15, or $1.80 over my net debit of $13.20 is a return of 13%, which is not bad given the time frame. So that's what I'm trying to do in my registered account. So for open, this is a good trade. Intel, it's profitable, not amazing, but Intel is usually flat. But I don't mind holding Intel, pays a small dividend as well. But that's the idea as well, doing covered calls on Intel as much as I can. HIMS, on the other hand, same intention, but it went the other way. The stock dropped to $8.37. My strike is 12.5. So now all I could do now is sell another call, but it's going to be very little premium, like maybe 20 cents or 25 cents. But I'm going to let it expire worthless. I'll give it a chance till August 20th, so next week. And then I'm going to sell a call option at 12.5 strike. But sadly, it's going to be, if I go to September, it's going to be worth maybe 20 cents. I might have to go further away to collect a bigger credit. Or another thing I could do is I could buy more shares of HIMS, so I can dollar cost average. So I could buy more shares at $8, bringing my cost lower, and then I could sell at a lower strike, and I'll have 2 contracts. So then the credit becomes worth it. But it depends if I want to put another 100 shares in this stock or not. I'm not sure yet. Then I've got BABA and gold. These are more like swing trades or even buy and hold, but they're not going in the right direction. I've got a cost basis on BABA at $201. I had a chance to close it before earnings for a small profit, or even break even. I held it through earnings, and now I'm down $400 on the stock because it dropped all the way down to 188. I might buy some more, but if it drops below 180, because I've already bought at 180. Actually, let's see if I can see my last. But yeah, see, I bought some at the lowest I've bought was 183. I feel like I've bought lower. This was executed July 27th. So I bought some July 26th and some more July 27th. So yeah, so my average cost basis right now is 201. All I could do right now is hold. And that's why I prefer to sell options. I don't have the patience for buying and holding. Although it is more rewarding, but right now I'm just holding, and it's annoying to see this, and there's nothing I can do but wait. If I had 100 shares, at least I'd be selling calls while I'm waiting. But now I don't have 100 shares. It's gonna take. I'm not comfortable buying either 100 shares of Alibaba right now. But yeah, so it's a little bit annoying. But I guess all I could do right now is wait. And I've got gold here. I thought it would be a good idea to buy some gold, but it just keeps dropping. I've got an average price of 169. Stock is at, or ETF's at 166. So yeah, so that's my TFSA, but I still got some cash available, so I'm ready to buy more stuff if something drops hard. So in my RRSP now, I've got total equity of 52 Canadian, but I've got a lot of cash available as well. Combined Canadian 37. And once again, I'm not using all my cash just because this market is at all-time highs. I don't understand what's going on, and I'm just being prepared in case there's a big crash or anything. At least I'm gonna have cash available to make new trades and not be on the sidelines like in March 2020. So, and plus I don't know what to buy. Everything is super expensive. So in the positions that I've got in my RSP, they're pretty bad. I mean, they're mostly covered calls, but I thought the entries would be good, but entries ended up being not good because the stock just kept dropping. Actually, this one's not doing bad. This one is not that far off. I mean, average, got a cover call 12.5 strike. Let's see what my cost basis is. AVPT is, I can't see it. What's my expiry? My expiry is August 20th. Okay, so it should be up there. So okay, so my net debit is $10.90. The stock is trading at 968. So it's not that far off. I could sell another call at 12.5 after August 20th. I might have to go maybe further just to collect a decent credit. So it's not amazing, but it's not like a 50% drop like Sumo or something. Then I've got Butterfly here. This one's not bad as well, not far off. My cost basis is BFLY is 11.45, and the stock is at 10.72. So really not far off either. I could just sell another call at 12.5. So this one's not bad. This one's pretty far. Yeah, Luminar here is pretty bad. I've got a 25 strike. My cost basis is pretty low though. My cost basis on Luminar is 21.43. So that's my cost basis. So I'm not far off, but the next premium that I'm going to sell, the next call option that I'm going to sell, I'm not going to be able to sell at a 25 call. I'm going to have to bring my call lower. So I'm most likely, I don't want to go below my cost basis. So I'm probably going to sell a call at 22.5. Try to collect $1 or something. And yeah, at least I come out profitable. It won't be as profitable as my initial entry or intention because I bought the stock at 29. My first call option, my first call that I sold was a 30 strike. So I brought my strike all the way down as long as it stays above my cost basis. My cost basis being 21.43. So I collected enough credit to bring my cost basis lower. So my initial entry was my initial net cost or net debit was 24.2, but then I collected an extra 53 cents and then $1.04 and then $1.20. So it brought my cost basis all the way down to 21. So yeah, so that's what I've got here right now with Luminar. And then I've got, this is a SPAC, just there's nothing to say. It was a mistake and I'm just waiting for the SPAC to come back up above, or at least in my cost basis, and I'll close it at cost, I don't care. Then I've got a cover call on Rocket, which initially was doing good. I initially had a 22 strike. I accidentally sold a 23 strike, but whatever, my cost basis on Rocket is 18.54, which is not bad. The stock is trading at 19. So the stock is trading above my cost basis. That's good. Once this expires, or actually I could just roll it and I could just roll it to the next expiry, and I could sell a 22 strike and collect more credit, lowering my cost basis, and then eventually close the entire trade for a profit. So it's not bad. All right, so this is December 17th. So it's one of those bad ones that I had to roll all the way to December, like Sumo. So you could see, yeah, the stock's at 657. This one's terrible. There's nothing good to say about it, but this is a bad position. This one as well. My stock's at $5. Very sad. What's my cost basis on Root? That's why I only did one contract. I always start off with one contract because I have to assume that I could be wrong on the trade. I cannot go in with a lot of contracts. I've got to give room for error. This one, good thing I only did one contract. My cost basis is 13.5 and the stock is trading at 5. So I'm easily $8. I'm losing $8 on this one. All I could do, because it's not taking a lot of, I actually have two contracts on this one. Damn. So So I'm down $1,600 on this one. So all I could do is keep rolling the call option. I'll have to go super far, probably like a year out. Definitely I'm gonna have to bring my strike lower. My cost base is 13, so I'm gonna bring my strike to $15. Now the goal is to lose less money, not to try to be profitable, but to lose less money. So I'm gonna bring here. Let's look at an example here. So I would have to buy back the existing calls. I would have to go all the way to the furthest I can go is December 2022. I would take a 15 strike, do 2 contracts, and see. It's not even that much. I would collect an extra 85 cents. And that's all the way to December 2022. But that's, if I want to do something, that's the only thing I could do right now. I could probably bring the strike lower, maybe 12.5, make it $1 collected instead. And what's my cost basis is 13.5. So that would put me at exactly break even. My max profit would be break even on this trade. So I would either do 12.5 if I just want to save the trade, or maybe 15. I mean, from 80 cents to $1, I'd probably just do 15, yeah. So that's the only thing I could do with Root right now. Then I've got Skills that has dropped a lot as well. So I'm just going to have to roll the call option, either bring the call strike lower. So where's Skills here? My cost basis is 15. So I could either bring the strike to 15, and so you're at a call and maybe go further out. So let's see, September 17, expiry, 15 strike, collect 27 cents. So that's pretty bad. So let's say I go to October, gonna collect 55 cents. So yeah, but if I stay at 17.5, which was my initial call strike, there's not much I can collect. So I might have to bring my strike lower. Next year I've got SNPR. This was a SPAC as well, turned bad. Well, it's not that far off, but I went all the way to December, so I can still wait, but I'll just have to keep rolling. And finally, Sofi. This one dropped a lot after earnings. I'm gonna have to roll. My initial strike is 20 call. Now I've got a few choices with this one, and I might just end up doing it, but if I just keep my position as is and sell the 20 strike for September, I'll collect 20 cents. If I go to October, I'll collect 65 cents. So I could probably do that. I could also bring my strike as low as my cost basis. My cost basis on Sofi is 17. So I could bring my strike lower, giving up the initial credit that I collected initially. So now my max profit will be the new credit that I'm collecting, because my strike now is at my cost basis. So I could do that and keep the trade, go to October. Actually, let's see what happens if I go to September. 56 cents. So I could go to October, collect $1, lowering my strike. So now my max profit would be about $1.50 because my cost basis is 17. Yeah. So I could do that. Or what I could do is I could buy another 100 shares of Sofi at a $15 price, lowering my cost basis. And then I could comfortably sell a strike at 17.5 because I bought initially at 19. If I buy again at 15, then my average cost will be about 17. So then I could sell a 17.5 strike, and therefore my potential profit will be higher if Sofi rallies back up. And I could do 2 contracts. So that could be a possibility if I like the stock, which I do. So I might do that. We'll see. I think I'll just wait till August 20th when this one is worth 3 cents. So I can buy back for nothing, but I could just let it expire worthless and then decide which call to sell next. But I'm definitely going to be selling calls. I'm not just going to be buying and holding. This one doesn't have options. That's why I can't sell calls. That's why you just see it here on its own. So if I look it up, OACB, yeah, it's got no options. All right, so next in my RESP, I've got 5 covered calls. I've got Bitcoin here, which is, I sold at a 6.5 strike in the stock, and then the ETF rallied to 8.6. So once again, I got caught on the call side, but at least it's profitable. If I look at my Bitcoin ETF here, my cost basis is $5.15. So the max I can close a trade for is 6.5. So I would still make a profit of almost $1.50. Not the best profit, but still a profit. So I'm not losing on this one. So I can't say this is a bad position. Then I've got Corsair here. The stock has dropped, but my cost basis is 27.75. So where's Corsair? CRSR. Cost basis 27.75. So I can comfortably just sell another call at a 30 strike, no problem. Here, let's see what I can get. If I add a call, sell, and then if I go to September and I take the same strike, 30, I can collect about 48 cents. If I bring it down to my cost basis, I can collect $1. But I think I'll keep it at 30, maybe even go to November because 48 cents is not much, and collect $1.70. So that could be a possibility with Corsair. And then next here, I've got Shift. This one was pretty profitable actually, but then it dropped hard, and now it's my cost basis. It's near break even. Well, it's slightly profitable, but my cost basis is I believe 6.15. Where's November? So SFT, yeah, 6.11. And I think at some point it was worth $7. This covered call was worth $7, so my profit would be the difference times 2 contracts. But now I think it's worth like 6.4. So it's slightly profitable, but not enough to close. So I'm just gonna have to hold on to it, nothing to do. And come November, I'll just roll it again if I have to. Now these two, there's not really nothing to say. This is terrible. I've got well, here they have different cost bases, but the stock's trading at 7.55, and you can see that my initial entry is very high. So this, I'm thinking of adding another 100 shares. I already have, I already have about 3,200 in Wish. So might as well, what's another, even if it goes to zero, what's another $700? But at least I try to save it. I'm thinking of buying another 100 shares, lowering my cost basis, so then I can sell a covered call at a lower strike. Now, my cost basis on Wish, I've got 2 positions. So one of them is $17 and the other one is $15. So I could buy another 100 shares at $7, which will bring my total cost basis lower. Maybe I think it'll bring it to around $13. And then I'll have 300 shares at around $13 cost basis, on which I can sell a call option at a 13 strike. What I don't get with Wish is that it was part of the short squeeze at some point, and it flew to $15, and now I don't know. Now it's down to $7. Actually, let's look at the yeah, there you go, right over here. So I'm hoping it can happen again. That would be great. But yeah, right now I'm stuck with this position. All I could do is roll the call option and wait for the stock to recover. So that's basically my story. I guess that's many of these positions. I'm just rolling and waiting for the stock to recover, and that comes down to bad entries. But I mean, I still have some profitable trades, and I still have enough equity to place new trades if an opportunity comes along. That's what's important right now. So yeah, just wanted to share my portfolio and my thought process on how I plan on managing my portfolio. So margin account, selling puts. Registered accounts is buying covered calls at the money when the stock drops considerably. When a stock that I like drops considerably, and the premiums are nice. If you have any questions, leave them in the comment section below. If like always, if you can open an account with Questrade to sell options, use my referral link below to get $50 in free commissions. Also, check out the other referral links below. I've got a trade alerts group as well on WhatsApp where I simply share my trades. So I'm not giving recommendations, I'm just sharing what I do. So if it's something that you're interested or want a copy, I don't mind at all. So check out the link below. If you enjoyed this video, click the like button, share with a friend, and subscribe to the channel. Thanks for watching.